Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. And with regards to that, we are expecting votes around 3 o'clock. I'm not sure how long they'll be, but it shouldn't probably take over much of an hour, but we'll see, give or take some time. But we do anticipate that happening, so hope everybody be able to bear with us. Today, this hearing is entitled The State of Bank Lending in America. Before we begin, I'd like to thank the witnesses for appearing today. We appreciate your participation and look forward to a robust conversation. I now recognize myself for 5 minutes for the purposes of delivering an open statement. In her testimony before the Senate Banking Committee last month, Chair Yellen painted a rosy picture of economic recovery and widespread credit availability. Chair Yellen supported her assertion by referring to the study conducted by one of our witnesses today, Holly Waite, of the National Federation of Independent Businesses. What Chair Yellen neglected to mention was that half the small businesses surveyed by NFIB said that while they were optimistic about the future, they were still sitting on the credit sidelines. She also failed to highlight the fact that 30% of small business respondents said that taxes, regulations, and red tape were their top business problems. Simply put, the picture she painted last month doesn't match the reality that small businesses and their employees live every day. Like so many others in Washington, I don't think she quite gets it. The truth of the matter is that we have what some have referred to as a two-speed economy. Since the 2016 elections, consumer confidence is high. Unemployment rates are trending down, and the economy is starting to show signs of life. While the nation's economic health may be improving, many of our citizens continue to face significant headwinds as they seek to grow their businesses or build a better life for their families. So today we will scratch beneath the surface to examine what's happening in our economy and how it's impacting American consumers and small businesses. The unfortunate reality is that a significant number of borrowers are, as Ms. Wade's work demonstrates, sitting on the sidelines. And small banks, consumers, and small businesses continue to operate in a stalled economy with limited access to credit. Data from the Federal Reserve Bank of St. Louis indicates that in the years before passage of Dodd-Frank, small bank lending was more than 150% above large bank lending. In the 6 years after Dodd-Frank, small bank lending was almost 80% below large bank lending. And the reality is that community financial institutions are the primary small business lenders. Today, nearly half of small businesses and startups don't get the financing they seek. And the situation for consumers that have a less than pristine credit history or collateral isn't as bright as it should be. This week, the New York Fed released a study indicating that 1 in 3 Americans couldn't come up with $2,000 if faced with an emergency. So despite seemingly low unemployment rates, people are still living paycheck to paycheck, preventing them from achieving the economic stability all Americans deserve. Despite the rhetoric fed to us since its passage, consumers and small businesses haven't been protected by Dodd-Frank. Rather, the rules and regulations billed as a pathway to a stable economy have stifled small business institutions and led to more restricted access and much more expensive credit. Even the Consumer Financial Protection Bureau, which purports to protect consumers, has smothered innovation and financial products that Americans want and need. The result is that consumers and small businesses, the drivers of our economy, are left sitting on the sidelines and struggling to survive. Today's conversations may be one of the more important ones that we have. It will serve to examine an alarming trend that should be on the front page of every newspaper in America and to better understand the actual impact the regulatory climate has on banks and their customers. I thank our witnesses for their time today. We look forward to your testimony. The chair now recognizes the ranking member of the subcommittee, the gentleman from Missouri, Mr. Clay, for 5 minutes for an opening statement. Mr. Clay.
Thank you, Mr. Chairman, for calling today's hearing to examine the state of bank lending, and I appreciate the witnesses participating in today's hearing. Prudent bank lending is key to a sound banking system and a strong economy. Excessive bank lending without appropriate safeguards has proven to lead to a devastating financial crisis. This is why Dodd-Frank focused on restoring reasonable safeguards to better protect consumers from the kind of predatory lending that hurt so many people just a few years ago. Despite assertions by President Trump and our friends on the other side of the aisle that community banks and lending was crushed because of Dodd-Frank, the data tells a different story. As Joe Friday used to say, just the facts, ma'am. And here they are. Banks have done quite well the past few years and posted an all-time record in profits in 2016, making more than $171 billion. The number of unprofitable banks have not been this low since 1995, more than 2 decades ago. Very few small business owners report problems getting access to credit when they want it. And in fact, bank loans to businesses also hit an all-time high after increasing by 75% since Dodd-Frank became law. And how are community banks doing? According to recent FDIC data, community banks are outpacing their larger competitors. Community bank lending increased by more than 8% last year, and they increased small loans to businesses at more than twice the rate of their peers. Community bank annual profits rose by more than 10% over the prior year. In the words of a Houston Chronicle article for my friends from Texas, quote, "Alternative facts underlie Trump's push to ditch Wall Street regulations. Dodd-Frank isn't making it harder for businesses to get loans." And I hope with today's hearing we examine the real facts and have a good discussion on sensible, targeted steps, not ideological rollbacks of Dodd-Frank, that we should consider to help small banks continue to lend responsibly to our communities. And Mr. Chairman, with that, I yield back.
Gentleman yields back. Thank him for his statement. Today, we welcome the testimony of Mr. Scott Heitkamp, President and Chief Executive Officer of the Value Bank Texas. On behalf of the Independent Community Bankers of America, I understand he needs to leave about 4:30 to catch a plane, otherwise he's going to be stuck in our beautiful city here for a while, and I don't wish that on anybody, especially if you're not a tourist. So we will excuse him, and so it's a heads up to all the members. If you do have some questions of Mr. Heitkamp, please make sure you get those out first so we do get his testimony. Ms. Holly Wade, Director, Research and Policy Analysis, National Federation of Independent Businesses, we welcome you. Mr. David Motley, President, Colonial Companies, on behalf of Mortgage Bankers Association, welcome. And Mr. Michael Calhoun, President, Center for Responsible Lending, welcome. Each of you recognized for 5 minutes to give an oral presentation or testimony without objection. Each of your written statements we've made part of the record. Some of you have been here before, know how our lighting system works. Red means go, you got 5 minutes. With 1 minute left, it'll turn yellow. And whenever it turns red, that means I get to do this. So we'll all be ready for your stuff. So with that, I recognize Mr. Heitkamp. You're recognized for 5 minutes.
Thank you, Chairman Lukemeyer, Ranking Member Clay, and members of the subcommittee. My name is Scott Heitkamp, and I'm President and CEO of Value Bank Texas in Corpus Christi, Texas. I'm also Chairman of the Independent Community Bankers of America, and I am testifying today on behalf of more than 5,800 community banks we represent. Thank you for convening today's hearing on state of bank lending in America. Despite some recent positive news on the state of bank lending, now is not the time to be complacent. From my viewpoint as a community banker in South Texas, and from my conversations with hundreds of community bankers from around the country, I promise you that the economic recovery is lukewarm, uneven, and fragile. This view is supported by data that, when broken down, shows a recovery that's mixed at best, with notable regional differences in need of strong solutions. Today, a customer with pristine credit score or a large established business can get a loan. But this isn't the measure of a strong economy. When the credit box is tight, we have subpar economic growth. To break out of this rut and strengthen economic growth, we must expand credit availability to millions of hardworking households and would-be borrowers with less than perfect credit scores. Many of these borrowers are in the middle to lower end of the income scale. Today's regulatory environment has choked off community banks' ability to take on and manage reasonable credit risk. Before I discuss ICB's recommendations, I'd like to give you some background on my bank. Value Bank Texas was chartered in 1967 and later acquired by my father. I'm proud to carry on that legacy. Today, Value Bank Texas is a $213 million bank with 10 offices in Corpus Christi and Houston and 114 employees. We specialize in small business and residential mortgage lending. As our name suggests, we are dedicated to creating value for our customers and our community. We are like thousands of community banks across the country with a vested interest in the success of our communities we serve today and for generations to come. Unfortunately, the number of community banks is rapidly declining. Today, there are some 1,700 fewer community banks than there were in 2010. This historic consolidation will harm competition and leave many small communities stranded without a local community bank. Any review of the health of today's community banking industry must take into account consolidation and the lack of de novo charters. I believe this consolidation and the lack of charter formation is due to the rise in regulatory burden. Today's banks need a larger scale to amortize the sharply increased cost of compliance. These same costs have a chilling effect on new charters. We need regulatory relief that will slow the consolidation trend and encourage new charters, creating a more vibrant financial system for the benefit of our customers and small business owners. According to a recent Urban Institute study, tight credit killed 1.1 million mortgages in 2015 alone. These would-be borrowers are people with lower credit scores and lower income. The study found that the tight credit was directly related to regulatory restrictions. One of the bright spots in today's economy is the surge in optimism among small business owners, as shown in the NFIB survey. This optimism will lead to a growing demand for credit, and we must ensure the regulatory environment allows community banks to meet that demand. The good news is that we have solutions. ICB's Plan for Prosperity is a robust regulatory relief agenda with nearly 40 recommendations that will allow Main Street and rural America to prosper. A copy of that plan is attached to my written statement. This committee's work in the last Congress set the stage for enacting meaningful regulatory relief. I want to highlight the CLEAR Act, soon to be reintroduced by Chairman Lukemeyer. I also look forward to the reintroduction of Chairman Hensling's Financial Choice Act. These bills, among others before the committee, are all part of the solutions to regulatory burden. We strongly encourage this committee to complete the work that was started in the last Congress and enact meaningful regulatory relief for community banks. Thank you again for this opportunity to testify, and I look forward to your questions.
Gentleman yields back. With that, Ms. Wade, you're recognized for 5 minutes.
Good afternoon, Chairman Lukemeyer, Ranking Member Clay, and members of the subcommittee.
Ms. Wade, can you either pull the microphone much closer to you or you need to speak right into it or turn it on, one or the other? Okay.
Okay, there we go.
There we go.
Thanks.
Take a bite out of it. Be all right. Thank you.
Good afternoon, Chairman Lukemeyer, Ranking
You got to
Member
remember, you have a lot of
Clay.
old people up here. That you got to speak up. A lot of old people over here. Okay.
And members of the Subcommittee on Financial Institutions and Consumer Credit. Thank you for the opportunity to testify today on the state of bank lending in America. Small businesses' ability to access financing is a vital component of a healthy small business sector. Small businesses rely on financing for general business operations, but also expansion activities and reinvestment. NFIB regularly studies banking activities and borrowing trends among small business owners. NFIB's Small Business Economic Trends Survey offers a monthly update on borrowing and lending trends among a random sample of NFIB's 325,000 small business members, a survey NFIB has conducted since 1973. Since the recession, loan demand has remained historically weak, even with record low interest rates still available. The percent of regular borrowers has remained in the low 30s with little pickup throughout the recovery, whereas previous expansions experienced a level of regular borrowing closer to 40%. High numbers of firms remain on the credit sidelines, seeing no good reason to borrow. The survey also asks owners if they were able to satisfy their borrowing needs over the last 3 months. In recent years, about 4% report that they were not able to satisfy their borrowing needs, significantly lower than the record high of 11% reached in 2010. These trends are further reflected in NFIB's Small Business Problems and Priorities Survey that asks small business owners to evaluate 75 business-related problems. From 2012 to the current 2016 report, financing has become less of an issue for many owners, with fewer interested in borrowing due to slow economic growth, but also due to better balance sheets for those seeking credit. The ranking for obtaining long-term and short-term business loans both fell precipitously from 2012 to 2016. The former fell 13 positions to its current ranking of 69 out of 75 issues, and the latter 12 positions to the ranking of 70th. The percent of owners finding each a critical issue also fell from about 11% to 6% in the current report. But there are a few pockets of small businesses that do have more difficulty accessing credit than the general population. Businesses experiencing declining sales of more than 10%, and those experiencing rapid growth of 50% or more over the last 3 years. The difficulties of the former are generally self-explanatory, but the latter is of significant concern as those businesses generate jobs and economic growth. For example, obtaining short-term and long-term loans currently ranks 39th and 42nd, respectively, for high-growth firms, roughly 30 positions higher than the ranking for the overall population, and more than twice as many owners find each a critical issue. The reasons why high-growth small businesses have a more difficult time obtaining credit compared to years past are less obvious, but the decline in the number of small community banks is of particular concern. Small business owners are far more successful accessing credit through smaller regional banks than larger ones. A recent Federal Reserve survey found that while 76% of small business applicants were approved for some credit at small banks, only 58% were approved at larger banks. The downward trend of commercial banks is not new, but over the last 8 years, the number of commercial banks has dropped from about 7,000 in 2009 to its current level of about 5,000. The importance of these banks cannot be overstated for small businesses, but also for the banking system itself. NFIB worries that overregulating these smaller community banks will create more bank consolidation and deter new bank formations. Loans to these small businesses are critical to the health of local communities and collectively to the health of the small business sector. With recent improvements in small business optimism, owners are in a good position to grow and reinvest in their business. If this occurs, borrowing activities should pick up. Market forces, not regulators in Washington, should manage the supply and price of banking services and loans so that small business financing remains available for potential increase in small business borrowing. I appreciate the opportunity to discuss the current state of small business financing and the challenges it faces going forward, and look forward to working with the committee to support small businesses and strengthen the U.S. economy. Thank you.
Thank you, Ms. Wade. You guys are doing great. Everybody's ahead of schedule here. Mr. Motley, you're recognized for 5 minutes.
Chairman Lukemeyer, Ranking Member Clay, and members of the subcommittee, I appreciate the opportunity to testify this afternoon on behalf of the Mortgage Bankers Association. MBA represents mortgage lenders of all sizes and business models, from small independent mortgage bankers to community banks like mine, to the nation's largest financial institutions. Each segment of our industry plays a unique and vital role in the market. As a 4-decade veteran of the mortgage industry, I can tell you from experience that recently enacted laws that have created commendable consumer protections and have made the mortgage market a safer place to do business. MBA has consistently supported reasonable requirements that will prevent a reemergence of housing and market disruptions. However, we must be mindful that new regulatory demands imposed under Dodd-Frank have also negatively impacted the availability and affordable and sustainable mortgage credit. MBA's data show that mortgage credit availability remains far below historic norms. As a result, many borrowers, too often already underserved populations, have been left on the sidelines. Now that most of Dodd-Frank's mortgage rules have been implemented, it's time to review these regulations and make the necessary adjustments. Let me highlight some of the key issues we feel would allow lenders to reach more creditworthy borrowers. There's no better place to start than with the CFPB's ability to repay rule. MBA appreciates the work of this committee and that of the CFPB to address some of the flaws in the qualified mortgage definition. We believe that rather than continuing to address the rule in a piecemeal fashion, now is the time to examine it holistically so that all lenders can deliver QM loans to a to consumers regardless of size or business model. To achieve this, we urge Congress and the Bureau to expand the legal safe harbor to all QM loans, increase the small loan threshold to fit more smaller balance loans under the QM umbrella, establish alternatives to the QM underwriting criteria to allow lenders to use other commonly accepted underwriting standards, broaden the ability for lenders to cure defects and technical errors in those loans, pass the Mortgage Choice Act, which would exclude title insurance fees paid to lender-affiliated companies from the calculation of points and fees. And finally, start the process of replacing the so-called QM patch by developing a transparent set of criteria to define QM. Beyond these QM changes, there are several other areas that should be addressed. First, as a mortgage servicer, I know the cost to service loans has increased dramatically. This is due to new CFPB rules as well as the punishing treatment of mortgage servicing rights under the Basel III framework. Under that rule, banks are required to hold extraordinary amounts of capital to support the MSA asset, making it less likely that banks like mine will retain mortgage servicing. Amid the backdrop of complicated and conflicting servicing rules, these increased costs directly impact consumer access to credit and make new loan production less attractive to lenders. Second, the CFPB should be required to provide authoritative written guidance to accompany its rules. The CFPB's resistance to providing timely written guidance has resulted in confusion, increased costs, and credit overlays by uncertain investors. This is particularly notable in the implementation of the know before you owe rule. Third, regulatory burdens on independent mortgage bankers need to be addressed. For example, state licensed lenders face frequent and duplicative examinations from the CFPB in each state in which they operate. MBA urges rationalizing this process by requiring the CFPB to adopt formal, risk-based standards for examinations and to better coordinate with the states. MBA also supports establishing an appeals process for CFPB exams that applies to both banks and non-banks and adoption of transitional licensing under the SAFE Act. Fourth, the Justice Department's enforcement action under the False Claims Act continue to have a chilling effect on lender participation in the FHA program. The resulting legal liability for what are oftentimes immaterial defects has forced lenders to impose new credit overlays or limit their involvement in FHA altogether. So long as the Justice Department continues to impose these draconian penalties on lenders for footfalls, the remaining FHA lenders will continue using overly cautious, defensive underwriting that limits options for borrowers. In conclusion, the current regulatory environment has increased costs and forced many responsible lenders to limit their lending. This harms consumers, most often low to moderate income borrowers, minorities, and first-time home buyers. We urge this subcommittee to do a thorough review of these rules and regulations and make adjustments where necessary. Done properly, we can balance the need for appropriate consumer protections while ensuring access to safe, sustainable mortgage credit. Thank you.
Gentleman's time has expired. Mr. Calhoun, recognize you for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Clay, members of the subcommittee for the opportunity to testify today on this important topic. The state of our banks is critical to our country's economic well-being. In my testimony today, I want to underscore 3 points, but focusing most on how best we can move our economy forward. First, as noted, data show that banks, and especially our community banks, are helping to spearhead our nation's economic recovery. My second point is that there are broadly supported steps that can be taken immediately to improve bank regulation and lending, and these should be implemented. And finally, we must reject, those proposals that would thwart the advancement of our economy. My testimony reflects my experience as president of the Center for Responsible Lending, but also as former general counsel of our lending affiliate, Self-Help Credit Union. It was established in 1982 to expand access to credit, and in the subsequent years has provided over $7 billion of financing for first-time home buyers, small business loans, and other consumer loans. Today, we serve more than 100,000 account holders with a full range of financial services. In the early 2000s, the Center for Responsible Lending was established in response to the growing predatory subprime home loans, and it works to promote sustainable lending. On the first point, as noted, after a long and painful recession, our financial institutions and the economy are recovering. and bank and credit union profitability is at near record level, and lending volumes, including commercial and industrial lending, are increasing. Community banks are doing particularly well, as are smaller lenders in general. This is a healthy sign, and as anyone in the banking industry knows, bank profits are still a very small part of the cost of financial services, usually 2% or less. Today's market is a welcome relief from the Great Recession, when banks, especially community banks, were hit so hard. The climb back has been hard, and while some contend that new regulations have depressed that return, numerous studies and data from government and private researchers show otherwise, and those are set out and discussed in my testimony. And I would note, for example, the Urban Institute, cited often, found that the QM rule, for example, was not restricting credit access. Looking first at the areas where we can move forward. With the ability to repay mortgage rule, that has been a common sense requirement, produced a better market, but there are ways that it can be improved. It includes, importantly, a two-tier approach. There are a number of important provisions where there's additional flexibility for smaller lenders. And in fact, the data is set out in our testimony show that mortgage growth since Dodd-Frank, mortgage originations, have grown the fastest for smaller lenders as opposed to largest lenders. As noted by my friend here, the housing area that maybe can be improved most quickly is FHA. The continuing uncertainty of the False Claims Act, as mentioned, is discouraging lending to first-time home buyers, which are a key lagging part of the overall housing market. In addition, FHA servicing requirements are poorly structured, harm lenders, consumers, and taxpayers alike. They should be reconciled and reformed to match up with other industry standards. A broader area for reform, and one that is often overlooked, is the Bank Secrecy Act and Anti-Money Laundering Act. It's essential to prevent terrorists and other criminals from using our financial services system as a vehicle to cause their harm. But these acts place a very heavy regulatory burden on banks, and most particularly on small banks. I can tell you the experience. I headed lending programs in our bank. It was one of the toughest regulatory burdens, and the ABA, in fact, in a survey of compliance officers, found it was the costliest regulatory burden. There is a pretty easy way, though, to substantially improve that, and that is simply to have ownership data collected when businesses are formed rather than placing that burden on the banks. Many groups, including ICBA, the Clearinghouse, and others, have endorsed this, and bipartisan bills have been introduced to implement it. It would be a major advance. The one thing we need to do is not step backwards, such as by thwarting the work of the CFPB or by creating huge gaping loopholes in the QM rules, such as having portfolio loans being swept in for all lenders. And I look forward to discussing that further with you during our questions. Thank you again.
Thank you, Mr. Calhoun. Thank all our witnesses for their testimony. Good job. The question and answer portion of our hearing starts, and the chair recognizes himself now for 5 minutes. The name of our hearing today is the state of bank lending in America, and I guess the first thing we need to establish is that there plenty of money to lend. Mr. Heitkamp, you represent the independent community banks. Is there plenty of money in the community banks to be able to address the needs of the citizens and businesses of the communities?
Our liquidity is strong. We have plenty of liquidity to lend. We're just looking forward to place it there.
Mr. Motley, what about you? Your mortgage bankers, you guys all ready to go? Jump in the market here, plenty of money to hand out to folks?
We have plenty of money to lend. The issue that we have is making sure that we're threading the needle to comply with the regulatory framework that we live with today.
Well, that was my next follow-up. Nice segue for me here. Once we establish the fact we've got the money, now we got to figure out why it's not getting to the people, or is it getting to the people? And if so, how are we helping people? Or are we not helping people? So that's the reason for the hearing today, find out what kind of lending was going on and what kind of lending is not going on. So to follow up with you, Mr. Motley, you indicated you made the comment that Dodd-Frank regulations are hurting lending, and you advocated a whole lot of different rules and regulation changes that would help implement a lot more lending. to continue to allow people to be able to participate in the economy, and I guess do it in a safe way. So would you like to elaborate on just a little bit of that?
Sure. You know, the QM rule did establish some basic prudent underwriting criteria, but it's very, very specific, and it relates to the Appendix Q underwriting guidelines that are referenced in the Act. Appendix Q was lifted from the FHA 4155 handbook, and that 4155 handbook is not particularly applicable to new types of households, to underserved people that are trying to enter the market, who might be trying to use multiple sources of income. There could be multiple households or generational households put into one household, and trying to fit that type of income documentation into the Appendix Q protocol is very difficult to do. So we believe that Appendix Q needs to be modified, that there needs to be an alternative or an expansion to Appendix Q to allow lenders to react to today's marketplace.
Okay, thank you. Mr. Heidkamp, had a banker come to me the other day, and he told me this story. He said, had a customer of mine who came into the bank. He's got a $500,000 home. He's wanting to sell it and buy another home. But he needed $250,000 to buy this other home. They didn't have that extra amount of cash. But he had less than 30 days to do the deal. And so he had a $500,000 asset that he really couldn't take advantage of because of the timing of all of the rules and regulations here. And so he had to cobble together a bunch of other assets to get to about $200,000. And yet the bank then made him a loan, but they said they were exposed for the other $50,000 of the $250,000 loan to him. And so if regulators would have come walking in that particular day and seen a loan like this that was secured by $200,000 basically worth of cash and a $50,000 exposure, what would have happened? And is this a common occurrence in your bank, the situations that the rules regulations are putting you in?
Yes, sir. I think we find that all the time. I think we have rules that are supposed to help us, but they hurt us, or help taking care of our borrowers. We have instances all the time when we have borrowers come into the bank asking for us to make them a loan. We want to make the loan. They've got plenty of assets. They've got plenty of...
And these are customers that you're...
These are our customers. I'll give you an instance. Last week, we had a lady, we're in a retirement community. Corpus Christi's down in South Texas, in the Gulf Coast, and people want to retire down in Corpus. They're coming from the Dallas area or the Houston area, want to retire. They have a home still left in their, where they lived. They're moving down. They're deciding either they want to rent that home or they want to sell it. But they want to come down to Corpus. They found a home they wanted to buy. They fell in love with the home. They came to the bank, said, we'd like to do this home. And through the QM qualifications, the debt-to-income level is 43%. They couldn't qualify. And our bank made a decision that we're not going to have non-QM loans, so we weren't going to take the risk of being sued and figuring out how that's going to work out later on. So good borrower, good capacity, felt for them, but we just couldn't take that risk.
Ms. Wade, very quickly, I'm about out of time here, but you made the comment in your testimony, the difference between small banks giving approvals to small businesses and large banks is about a 20-25% difference. Can you explain that difference, why the difference is there? I mean, if you had the identical customers, why are small banks doing a better job or being more liberal or more accommodating to small lenders, small businesses versus large banks?
Sure, thank you. From what we've heard from our members, small business owners, that generally the local community banks have a small business staff a person in the bank that knows the community, knows the area, and is better able to help them finance their business through lines of credit or traditional bank loans, compared to larger banks that might not have those local expertise that are needed.
Thank you. My time has expired. With that, we will recognize Mr. Meeks from New York for 5 minutes.
Thank you. Thank you, Mr. Chairman. I want to thank you. I think all of you made excellent presentations, and I think that I agree with you in that we've got to make sure that the pendulum didn't swing all the way the other way. You know, at one time we had no doc loans, et cetera, and anybody can get a loan. And now, in an effort, we've got to make sure the pendulum did not swing all the way the other way so that folks don't have access to loans and make sure that they are more available. And I know, and I compliment the small and community banks for what you have done. I said often, my parents probably would have never owned a home if it wasn't for a small bank that took a risk on them that they would be able to buy the home that they purchased. And so I know that Mr. Barr has a bill that he's working on, and I'm not on that bill yet, but I'm looking forward to continue to talk to you because with your Portfolio Loan and Mortgage Access Act, I think it may be heading in the direction that maybe we can do something in a bipartisan way. And so I look forward to continuing at least working with you in that vein, because I think this is tremendously important that we make sure there's access to you. Let me ask, yesterday I was reading in the American Banker an article that touched on how banks of all sizes, actually, and I really focused on the community bankers, are investing in small business loan funds so that to meet their CRA economic development goals. And while the funds allow the participating banks to mitigate risk and diversify their small business lending, the lending seems to be increasing access. And as a result, these funds allow small entrepreneurs to obtain the capital to finance their business ideas. So, Ms. Wade, would you talk about the impact, if you will, of the Community Reinvestment Act has had on increasing small businesses' access to capital, and are there things Congress can do or should do to increase CRA business loaning?
Thank you for the question. The members that we survey, I don't know how they're affected by that, but for the most part, they aren't seeing a whole lot of obstacles in gaining access. The problem that we see is that there isn't a lot of optimism or expansion opportunities for them to borrow. And so the lack of confidence in the economy growing, even if sales are increasing a bit, they aren't confident about expanding their business, reinvesting in their business, given the current state of the economy. And that's been one of their main problems in growing. And that's where we see the low borrowing rates from our members.
And let me ask Mr. Motley, because here's another reason, because oftentimes when people say CRA, they may think just urban America, but I think, urban America and rural America in certain areas, they have the same problems as far as access and finding and getting loans. So I'll ask Mr. Motley, do you think there is a way to strengthen CRA to incentivize banks to serve small, rural, as well as urban areas in these underserved communities? In other words, are there incentives that we can provide through CRA that to encourage more reasonable risk-taking by some banks so that the smaller, entrepreneurs can get access to capital?
Are you referring primarily to rural lending?
Rural and urban, I think they're similar. CRAs is to reinvest in communities that are not, that are underserved. So to help rural areas that are underserved, but also help urban areas that are underserved. So they both have more access to capital.
We satisfy our CRA opportunity primarily through low to moderate income lending with the FHA program. We do a little bit of lending on a commercial basis throughout our marketplace, and those are underwritten to our personal standards there in town. But one of the places that we have a tremendous challenge is in the rural areas and outlying areas is the appraisal process. There are very few appraisers available. It's difficult for us to get timely appraisals. And so that is a challenge to us being able to serve that rural neighborhood, both from a residential standpoint and from a commercial standpoint.
Let me ask, I got 29 seconds. I just wanted to find out from, maybe I'll ask Mr. Calhoun, CDFIs, and I saw that they were being zeroed out under the current budget. Could you tell me, is it the significance of CDFI funding and to small business communities, and what are you alarmed at all by ruling or zeroing out CDFIs?
Very quickly, CDFIs have played a leading role in providing that small business lending to particularly underserved parts of the market. And historically, the CDFI program has enjoyed strong bipartisan support for that reason.
Thank you. I'm out of time. I yield back.
Gentleman yields back. With that, we go to the Vice Chair of the committee, Mr. Rothfuss from Pennsylvania, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Heitkamp, I wanted to ask you a couple questions. Last week we had a hearing about the lack of de novo activity that we've been seeing, also a striking consolidation that's been going on in the community banks sector. I'm hearing from community banks on a regular basis and their customers about the post-crisis lending environment and the challenges they face in complying with all of the new regulations. Unfortunately, some on the other side of the aisle dismiss these complaints, telling us that bank lending is strong and that profits are high, so there cannot be any real problems. But I think that's a superficial view of the state of bank lending in our economy today. And what we have is a two-speed economy. There's one speed for the largest firms, individuals with the best credit and the biggest banks, and there's another speed for everybody else. As you noted in your testimony, quote, a customer with a pristine credit score or a larger established business can secure a loan. But those with less than perfect credit, middle and lower income Americans, and those trying to start small businesses are not finding it so easy to access capital. Community bank consolidation and the de novo drought have surely contributed to this bifurcation, since many of these groups would normally turn to community banks for capital. In fact, lending by smaller banks was more than 150% higher than large bank lending before Dodd-Frank, but today it is 80% below large bank lending. Can you describe how regulatory burdens play a role in creating this two-speed economy?
Yes, sir. I think when you look at it and you see the difference with the regulatory burden and talking about de novo charters, I think that's the reason why we have a lack of de novo charters is the regulatory burden. You're looking at why you would take that risk and getting involved with the regulatory environment today, is you're seeing a lot of people saying there's too many rigs, too many regulations and risks to put my money at work to take that risk.
Can you identify or tell us why certain regulations disproportionately disadvantage smaller banks?
Our compliance costs are through the roof. I can give you, in my bank, for instance, in the last 5-7 years, I have a compliance person, I have a checker of the compliance person, I have people doing the job day to day, and we're looking at that burden every day, making sure that we don't make a mistake, because that mistake will cost us a lot. So the compliance cost is a lot of the burden that we have to deal with.
And how has your bank's lending activity changed as a result of Dodd-Frank?
Our loan-to-deposit ratio is about 70%. We keep it about 80%. It's down about $10 million in the last 5 years. We've been struggling to keep it there. We're trying to hire new people to get it involved, but overall compliance and just the lack of the small to mid-sized customer not having that flexibility where you can come in and sit across the desk and say, I can take that risk with you, with that regulatory risk that we need to take. We're not willing to do that, so it's forcing some of those customers not to have that credit.
Mr. Motley, if I could ask you a couple of questions. In your testimony, you discussed the tremendous uncertainty about how the CFPB will approach various compliance issues. You wrote, quote, despite the extensive liability that can arise from TILA, or the Truth in Lending Act, violations, the CFPB has largely foregone providing guidance on TRID, taking the position that such questions will be settled by the courts. Can you describe how CFPB's regulation by enforcement impacts consumers?
Sure. You know, we can mitigate credit risk. We can mitigate rate risk. We have a very difficult time mitigating regulatory risk because the rules have not been clearly defined in every case. And when we ask for rule clarifications, we get webinars, we get presentations, but at the bottom of every one of those presentations it says you cannot rely on this as being authoritative. You must rely on written guidance, and yet we don't get that written guidance from the CFPB. So it makes it more difficult for us to lend. And when we're faced with the possibility of a loan being kicked out of a pool or a challenge in court at foreclosure time, if there's a problem with the regulatory issues with the disclosures, we're going to run into a problem with that. So we're more likely to take a more conservative approach and lend very much within the credit box rather than out to the edge of the credit box. And if we had more regulatory clarity from CFPB in terms of written guidance, I think that all lenders would be more likely to lend to the edges of that credit box and live within the rules.
Thanks, Chairman. Yield back.
Gentleman's time has expired. With that, we recognize the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Thank the witnesses for appearing as well. And Mr. Chairman, I want to especially thank you for styling the hearing today. You styled it the state of bank lending in America. You didn't say horrible bank lending. There's so many adjectives that you could have used, and you did not. And I must tell you, I appreciate it. It gives each side an opportunity to make the case and to hear evidence, if you will, hearkening back to a prior life. So thank you for your balanced approach to styling this hearing. I am one who believes that community banks, by a given definition, should be aided in every possible way. We do, from time to time, have difficulty defining community bank. 89 to 90% of all banks are $1 billion and under. $1 billion and under. We have tried to fashion rules to cover 90% of all banks, rounding up. But the problem that we run into is that when we try to do this, there's a desire to go through the entire additional 10% or to some additional portion of the 10% that wouldn't be covered. We tried to do this with H.R. 2642, Community Lender Regulatory Relief and Consumer Protection Act of 2015. Lots of relief for what I call community banks. My friend from Texas, your bank started in 1967, $213 million, 114 employees, am I correct?
Yes, sir.
Good bank, by the way. I compliment you. That was not a commercial, but I compliment you. If we could fashion a bill to cover all banks at $1 billion and under, would your association in Texas support that bill to cover banks at $1 billion and under, as opposed to up to the $50 billion level?
Well, I think you got to look at it in a way of what a community bank is.
Yes.
That
See,
$1 billion and under.
This is where we run into the problem. Go right ahead.
Yeah. You know,
This is where we
you
run
just
into
put a
the problem.
threshold out there to $1 billion and under. There's community banks that really serve their community that are.
If I may reclaim my time, we're talking about a bill that would cover 90% of all of the banks in the country. Most of them are $1 billion and under, but this is exactly where we go when we try to fashion the bill for the 90%. It becomes a question of how do we get to the $50 billion banks? I want to help, and I believe that we can do something now as opposed to continuing to put it off until we can get the $50 billion banks in. And $50 billion is the number that I'm throwing out, and most of you know why. That's where the trigger is. That's where the trigger is. What trigger, you ask? The trigger for living wills, the trigger for SIFI designation. Those are things that we could debate at a later time. If we could help the 90% of all banks that are under $1 billion. These are the community banks. These are the small banks that you talk about, but when we get ready to legislate, we have to go to $50 billion. So I'm with you on the small bank issue that you raise, but it's just that when we try to do something for you, it goes to $50 billion. At some point, you're going to have to let them go. You will have to let them go. We'll deal with them. You don't have to carry their water. It's good water. Let them carry it. I yield back.
Gentleman yields back. With that, we go to the gentleman from Kentucky, Mr. Barr. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Thanks for the great hearing, and appreciate the testimony from our witnesses. And I'm actually asking you all to take a look at a slide that my friends on the other side of the aisle have been displaying during their questioning. And they're citing Federal Reserve statistics and saying that business lending has actually increased after Dodd-Frank, citing commercial industrial bank loans at a record high. I want to kind of dig deep at this because, as the ranking member of the subcommittee pointed out, just the facts. This, in my judgment, reading about trends since Dodd-Frank is not just the facts. There's other facts, there's context that I think we have to put into this. About 25 years ago, small banks under $1 billion in assets, total industry assets were around 30%. $1 billion to $10 billion, about 35%, and those bigger banks over $10 billion, about 35%. Today, it's a dramatically different picture. Today, total industry assets for these community banks under $1 billion is less than 12% of all total industry assets as I look at the statistics. And we know that since Dodd-Frank, we've got 1,700 fewer community banks than there were in 2010. So what the real picture says is that lending from community banks is off. It's much less. And so to the extent there's business lending increasing, it's coming from the larger banks, and it's benefiting larger borrowers. So emerging growth companies, small businesses, entrepreneurs, sole proprietors, the real engine of economic dynamism, the job creators, that's off. That's way down. And that's what that slide doesn't show. And here's why that matters to me. I represent a district in rural Kentucky. And three-fourths of all lending in rural America come from those small community banks. In fact, the community banks in my district, some of them are less than $100 million in assets. And that lending is way off. So that's where the concern is. Small bank lending in rural America, small bank lending, where we're talking about half of all small business lending comes from these community banks. So Mr. Heitkamp, as the representative of the community banks here, can you elaborate, is that analysis correct, and is that an explanation for why this slide that my friends on the other side of the aisle, why that slide is totally misleading?
Yeah, I think that's definitely a good conclusion, that you're seeing a lot of larger credits and larger banks happening, $5, $10, $15, $20 million, that drive up that data, that's just hard data. When you break down the data, you look at like you said, community banks make 50% or better than 50% of all small business loans, and I believe we do that. It's getting harder for us to do because of the credit box that we're in with the regulatory burdens. We can't take that additional risk. Years ago, 7 years ago, 10 years ago, 7 out of 10 small businesses came out of a small bank. You look at some of the Dells or you look at some of the big companies, 7 of those took the risk. Some community bank took the risk with those guys. And so that's why I think we're having the challenge that we have today with the regulatory box that we're in.
Well, we've lost 1 in 5 banks in Kentucky since Dodd-Frank. That's a problem. 1 in 5 credit unions as well. And I think that's compromising access to credit for the small businesses and for rural America. I want to switch over to Ms. Wade and Mr. Motley for a minute, especially Mr. Motley on the portfolio lending legislation. Mr. Calhoun is concerned in his testimony that portfolio lending is dangerous. With all of the exams that occur, and Mr. Heitkamp, you can weigh in here as well, with all of the scrutiny and the supervision that's happening right now, is Mr. Calhoun right that there's a risk with portfolio lending?
I think that there is the potential to put loans in portfolio that might not be prudent over time. And particularly if we're going to define a community bank by size varies, asset sizes vary. And so if you set a threshold of $1 billion, let's say, and then you go above or below, and now you've got different regimes of rules that you have to comply with, I think that a better approach is to make the QM rule, make a few revisions to the QM rule that would be applicable to all players in the marketplace, rather than putting it in just whether or not it's in the portfolio.
In my remaining time, we see from HMDA data that there's been a big drop in lending to manufactured housing loans. Based on your knowledge in the marketplace, do you think Congress should act to alleviate the harm to borrowers in the manufactured housing space? Mr. Heitkamp?
We're in a coastal community, so we don't have a lot of mobile homes because of the windstorms rules. So I can't really answer there. That would
Okay. My time has expired. I yield back.
Gentleman's time has expired. With that, to go to the gentleman from Washington, Mr. Hecht, recognized for 5 minutes.
Thank you, Mr. Chairman, very much. I'd like to begin just by making an observation about something which Mr. Motley suggested, namely that there can be risk involved in portfolio lending. I am painfully reminded of Washington Mutual, which kept their mortgages or a good percentage of them in portfolio, and it didn't stop them from taking on risks that they thought they could stay ahead of because those homes would be turned at some point and the dance would never end, but of course it did. I actually want to ask about mortgages. Mr. Motley, let me start with you if I may. There seems to be a new stubborn structural disparity between how many housing units we're creating and what the demand is. And in certain communities where never before have we had this structural difference between supply and demand, we just can't seem to get out ahead of it. Last I read, I think we're at an annual rate now of 1.2 million. Demand for that is obviously higher. And as though I needed proof, and I don't, I have a very dear friend who bought a home in Seattle about 30 years ago, and they finally decided to move into a senior assisted center. They sold their home this was a modest, nice, but modest 3-bedroom cottage kind of home, bungalow kind of home. They sold it on the first day they listed it for $150,000 more than asking price. And that's what's happening in a lot of areas in the Seattle market. And I'm very concerned about this and about what it is that we can do moving forward. I'm from the school that says that reasons that we have this problem with lending and, in fact, in providing for housing is almost always more three-dimensional and complex than most people want to give it credit for. But I'm interested, as speaking on behalf of mortgage bankers, what you might have to observe about this new phenomenon of there being structural differences between supply and demand, including in, for example, some Midwestern communities that we had not gone through this quite as we are this time. So what can you say that might provide insight or help with respect to understanding where we are in the housing market? Fair question of you, Mr. Motley?
Okay, let me see if I can answer that or give you my opinion on it. There have been, there are significant challenges in the first-time homebuyer market in the low-income area of housing where people need to get in, want to get into housing, but because of the cost, they just can't do it. What are some of the issues that are involved in that cost? Well, local regulations, land costs, very, very high. Regulations with regard to new construction have been imposed and it makes it very, very difficult for builders these days to build a low to moderate income house and make
any money at it.
Right, right. And so there's that supply issue. But then also from the mortgage side, and this is one of the things that I would ask you to consider about the QM rule. The QM rule says that you cannot, and I'm going to defer to my friend Mike here on the exact formulation, there is a APR cap that says that the interest rate or the APR cannot be more than 1.5% over the average prime offer rate. Well, that's a very narrow range, and what happens when you go over that APOR by 1.5, it becomes a non-QM loan. Non-QM loans are not liquid. They're not fungible in the marketplace. They're viewed as toxic. And so one of the things that we propose.
Excuse me, Mr. Motley, but that's a very interesting point. Thank you. But if I understood you correctly, you're suggesting that that in order to be a more liquid market and a more attractive market to lenders, that you need to be able to charge more to the people who are on the low income end of.
I'm just saying that's the way the calculation works out when you have a low balance loan, because there are fees like title fees that are fixed fees, not a percentage of the loan amount. You have to add those fees into the calculation to get to that APOR, and if you go over that threshold,
right,
it becomes a non-QM loan.
So I'd be interested in Mr. Calhoun. Would you be supportive of that change as well, sir?
We did support that and have for a long time and sent our written testimony. And the effect of giving that 50 basis points extra of cushion is equivalent in allowing 4 extra points of closing costs. So it doesn't look like a lot, but since it's an ongoing 50 basis points, that provides a good bit of additional room without creating, it's one of those places where we can tweak this and without creating harm. I would note the CFPB has started its review of the whole QM rule, as they're required to do on all their significant rules every 5 years. And this
so
is thank
you both. In my 4 seconds left, let me just say thank you, Mr. Chair, for the opportunity to use this hearing to say that we ought to be spending a whole lot more time in talking about how to meet housing needs, how to get housing starts up, and it would solve a lot of problems in this economy and for the average American. And with that, I thank you, sir, and yield back.
Gentlemen's time has expired. They have called votes, but we're going to try and get 2 more people in before we leave. Mr. Williams from Texas is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to thank all the witnesses for being here today, and especially my fellow Texans for coming up here to D.C. I want to follow through on something Mr. Barr said earlier. Ms. Wade, you highlight the important role small business plays in economic growth, accounting for about half of the U.S. gross domestic product. Despite this importance, small businesses have struggled to secure credit since the passage of Dodd-Frank. I am a small business person, and I understand every bit of that. According to research by an analyst at the Federal Reserve Bank of Dallas using FFIEC data, small business loans at U.S. commercial banks have declined 15% since 2008, even while total business loans have increased 33%. As a result, small business loans have shrunk by almost 40% of the small business loans portfolio in 2004 to 20% in 2016. What has been the impact of reduced access to credit on small business, and how will increasing access to capital help small business?
Thank you. As I said, one of the problems is that there's just a lack of demand, generally speaking, in the small business community, where they don't have the confidence in seeing opportunities to expand, grow their business, or risk not knowing what the business conditions will be 6 months, a year down the road. And they're not willing to bet their own money on not a solid economic foundation in many of their communities. So the low borrowing levels is one of our main concerns. We did find, however, that there are more difficulties for those who are in high-growth small businesses, so those who have had over 50% growth in the last 3 years. Those businesses seem to be finding, on average, a more difficult time in accessing credit, and we are interested in looking into that further. That might be coming up against some of the regulations that are restricting community and smaller banks in lending to these businesses, and that's where a lot of our concern is focused in these more high-growth businesses that are having a more difficult time accessing credit. But in creating policies that are more business-friendly, those are the areas that we are focused in allowing small businesses to grow and improve their business and reinvesting, so that there is a strength in borrowing among the small business community.
All right, thank you. Mr. Heitkamp, in your testimony, you spoke about bank consolidation. Like many of the small businesses in my district, which you're familiar with, I too am a borrower. Can you tell me what these consolidations, these mergers mean to borrowers and communities locally?
Yes, sir. I think the mergers and acquisitions is really hurting the people trying to get credit. You see borrowers out there, and today when you lose a merger out of a community bank or it leaves that town doesn't have the access to capital. So a merger is a big issue, and the access to capital, and those people in those communities are not getting it. And so they're looking for other places to go online and other places. So it's not really driving what we need, real economic growth.
Mr. Motley, what has happened to your banking services since passage of Dodd-Frank, and have you had to reduce some books of business?
Have I had to reduce what?
Have you had to reduce some accounts, some books of business?
What's happened in our businesses since Dodd-Frank is that we've increased our staff of compliance personnel dramatically by a factor of probably 10. We spend these days, whereas we perhaps prior to the crisis we might have spent $10,000, $15,000 a month toward compliance issues, we now spend $350,000 a month in compliance, pre-funding QC, quality control areas. So it's dramatically increased our cost of business. In terms of have we had to turn business away, we never were a lender of those no income, no asset type loans to any significant extent. So when those products went away, that didn't affect us. We didn't really do those loans.
And all that money that you spent on compliance could have gone to customers, to build a business, to hire people, put people to work, create more taxpayers.
It could have reduced the cost to consumers, because when banks incur increased compliance costs or costs generally, those costs are going to get passed on to the consumer in one way or the other. So the cost of origination, if I could just take another second, has grown from $1,900 in 2004 for us to over $6,500 in 2016. The cost to originate a loan is dramatically higher than it used to be prior to the recession.
Well, thank you for your testimony, and I yield my time back.
Gentleman yields back. We're going to try and get one more individual in here before we recess. Mr. Laudermilk from Georgia is recognized for 5 minutes.
Thank you, Mr. Chairman, and I will try to be very brief with this. Mr. Heitkamp, last year, at the end of the year, statistics showed that banks with over $100 million in assets saw a growth in loans, but smaller banks saw a decrease. From a state that has lost a lot of community banks, we have some counties in our state that have no bank branch at all of a small or community bank. There's been a significant impact on Georgia. And with this, it makes me just wonder, why are we seeing this trend of larger banks are seeing an increase, and what are the challenges of our smaller banks, our community banks?
Yeah, I think you're seeing the consolidation. That's making a decision. If you're a small community, and I think $100 million is even pretty small today, they're saying you need to be half $500 million to survive with the new economic data or the regulatory burden that you need to survive to the increased cost.
So it goes back to the regulatory burden that we're putting on these guys.
You're looking at our costs have gone up 300% in the last 3 years on regulatory costs.
And what I'm getting from our community bankers is when I'm asking about, under Choice Act and Dodd-Frank, what is it that we need to correct? The answer I'm getting is death by 1,000 cuts. It's not just one thing, it's a death by 1,000 cuts. Could you elaborate a little bit more?
Well, I think all these things you're talking about, death by 1,000 cuts, every time you turn around, you're getting 1,200 pages of regulation or other, you look at HMDA, you look at increased data points there, you're looking at CFPB, you're looking at TRID, all the new things that Washington's putting out to us. We can't take care of the customer and take care of those costs, so you give to the customer because you have to take care of the other things because of the regulations.
Okay, thank you. Mr. Motley, one of the things that I've also heard coming from the banks is, tell us what the rules are. Just give us what the rules are. I remember when I was in the Air Force, we played a game of softball. But what we weren't told is what the rules are, and the rules continually change. So it was impossible for you to win because every time you went to bat, you may be given one pitch, you may be given 4 pitches. And I equate to what they're saying, especially in the mortgage industry, is we don't know what the rules are that we need to play by because they're evolving. Does that kind of hit where some of the problems are?
Yes, sir. Yes, sir, it is. And it goes back to my earlier statement. When you don't know what the rules are, you're going to try to take the safest route. Right. And you're going to stay away from the edges of the credit box because the penalties for making a mistake under the know before you roll rule, or really any of the QM rules, the ability to repay rules, all of those rules carry truth in lending liability. And that is significant. And so when we're not clear on what the rules are, we're going to pull back. We can quantify credit risk, we can quantify rate risk, we cannot quantify regulatory risk. And that's why we need to ask for, and I think we should expect to get, clear, written, reliable guidance from CFPB. We get that from the prudential regulators. We should be able to get it from CFPB.
And Congressman, if I may add just for the record that last year on the so-called TRID, or know before you owe, the CFPB did issue a notice that they would engage in formal guidance. They solicited comments, which I know MBA submitted, we did too, and you should expect in the forthcoming months, if not weeks, that there will be further official TRID guidance to help provide that clarity, because we agree with the need that unnecessary uncertainty has a high cost.
Mr. Motley, how long have we been asking for this directive?
Since the rule came out.
Okay, so it's been quite a while, very slow going. I asked one of my lenders, or one of our small banks, back just a few weeks ago, could you give me some incidences of where you haven't been able to loan money? And they said, we could give you many instances. For instance, there was a guy that we had loaned for a mortgage many times, and he paid has always been current. He came and asked for a loan for a new home, and we had to deny him. but we really couldn't tell him why. And I believe it was because exactly what you were saying is they're taking the safe route because they don't know what the rules are. And even though these directions may come out, will they change again? So with that, Mr. Chairman, I yield back.
Gentleman yields back. With that, we are going to stand in recess until after votes. The votes are, I think, about 4 of them, so we should be back within 35 to 40 minutes, so sometime around 10 till 4 till 4 o'clock. So if you'll bear with us, we should return. We stand in recess. let's go back to work. Again, thank you for your indulgence. Apologize for the interruption, but actually had to go to work a while ago. So thank you so much again for your patience. We will continue with Mr. Kostoff, a gentleman from Tennessee, is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm a recovering attorney and a former U.S. attorney, but also a former bank board member for a community bank. So I appreciate the comments and the testimony that many of you have offered. Mr. Heitkamp, if I can, going back to you, since the implementation of Dodd-Frank, in my opinion, we've seen a one-size-fits-all regulatory regime, regardless of a bank size, that has had a profound impact on a bank's ability to lend. Where I'm from in West Tennessee, I hear of many instances where longtime customers of their banks or financial institutions are unable to secure a personal or business loan due to the stringent requirements of Dodd-Frank. Problems like these, as we've heard today, are happening all too often, and consumers are finding it more difficult to access credit when they need it the most. If you could, in your experience, pre-Dodd-Frank and now post-Dodd-Frank, can you talk about the type of individuals that, just subjectively, that or anecdotally, that you could loan to before the implementation of Dodd-Frank and compare that to today?
I'll give it a shout, sure. I think looking back, I think I just did this in a talk the other day talking about what I did 10 years ago. 10 years ago, I took care of my customers, grew my business, and tried to grow my bank. Today, most of my time is spent trying to deal with new regulations or old regulations and how it's going to affect my bank. So I think that kind of sums up what you're talking about. But from a customer standpoint, you know, we talked about DTI, we talked about the loan requirements you have to do, the hurdles you have to get over. For good customers, that you're looking for those additional regulatory requirements that have been put on us because of Dodd-Frank. And I think that's our challenge, is trying to help those customers that you want to help and trying to figure out now how to do it. And sometimes you just can't.
You know, in my area of the world, and we talked to some bankers around West Tennessee and rural West Tennessee. Talked to a banker in rural West Tennessee, and I've got this in quotes because we took it down verbatim. He told us that a customer of his tried to refinance his primary residential loan. This is his words, when we requested verification of the income, the customer could not provide it because they had lost their job in the past year. However, for the past 12 months, the customer had made regularly timely payments on the loan. He managed to engage in what he called odd jobs and make the payments. But because of the requirements of the ability to repay, our bank was unable to refinance the loan for this specific customer. And if I could, Mr. Motley, maybe going to you, I believe you had testified that the fact that mortgage credit has tightened and the impact that it's had on customers, your customers, particularly low to moderate income borrowers, minorities and first-time home buyers. Can you elaborate, if you could, on the various factors that have led to the constriction of credit in general?
Was that directed to me? I'm sorry, I couldn't hear you.
Yes, sir.
Okay. Particularly in multicultural communities, it's common for families to pool their funds. That's not a standard way of documenting your ability to repay using the Appendix Q. Were it not for the patch, the GSE patch, the temporary patch, we would be very challenged to make the kinds of loans and the number of loans that we've made, because the debt-to-income ratio that we've documented based on the information that we have would be well above 43%. And yet we would see people who have perhaps made that housing payment before, the housing payment that they're proposing to have is equal to or maybe even less than, but it might still be over that 43% level. So it's going to be more difficult when that patch goes away in 2021 if we don't make some modifications to what the definition of a QM is. And so we propose some minor modifications, some tweaks that allow lenders to use alternative underwriting decisions and use some other alternative underwriting methods to demonstrate the ability to repay without the very prescriptive rules that are in Appendix Q and specifically the 43% debt ratio. So there are a number of different prototypes, if you will, or borrower types that I could go into. People that are recently out of college, for instance, that are trying to get into their first home, but they don't have a history of earnings. That type of thing is problematic under QM.
Thank you very much, and I believe my time has expired. Thank you.
Gentleman's time has expired. With that, we recognize the ranking member of the committee, the distinguished gentleman from the Show Me State, Mr. Clay. 5 minutes.
Thank you, Mr. Chair. Let me start with a question for both Mr. Heitkamp and Mr. Calhoun. Some suggest the declining rate of community financial institutions in this country is a recent phenomenon and one that started with the enactment of Dodd-Frank. And yet the facts, once again, do not support this. In the decades leading up to 1980, the total number of commercial banks fluctuated around 13,000 to 14,000. Since that time, there's been a steady decline at a rate of about 300 per year to just under 6,000. More than 80% of banks that exited the market over the past 30 years did not fail, but rather merged or consolidated with another bank utilizing interstate branching laws that were passed long before Dodd-Frank. And Mr. Heitkamp, aren't smaller banks being gobbled up by larger banks as a result of the institution's prosperity and success? Is that how you see this? Or?
No, sir, I don't. I see it kind of the opposite. I think when you start looking at mergers and consolidations, I think the banks that are looking for that are primarily because of regulatory burden that they're putting on. They cannot survive, and their costs are going up, so it's driving them to make a decision for viability and for their shareholders to sell their bank. And so you're seeing mergers driven, in my opinion, based upon that decision. I mean, we struggle with ourselves. We're a $213 million bank. Does it make sense for our shareholders to keep absorbing and seeing our income go down?
Thank you for that response. Mr. Calhoun, how do you see it?
Well, a couple points here. The biggest impact on community banks have been the fallout of the Great Recession. We saw almost 500 community banks shuttered. They were the primary banks that got closed for financial difficulties as a result of the Great Recession. And then I think you've heard from many witnesses here, the two biggest challenges in small business lending are first, reduced demand because those businesses are still recovering from the Great Recession, and one that hasn't been mentioned yet, and that is extremely and artificially low interest rates make it extremely difficult for us as small lenders to take deposits and lend and make a living off the difference when interest rates have been depressed so low. That said, let me be clear, as I said in our written testimony, we both support a two-tier approach to the regulation and an expansion of the existing measures that have been taken in that regard. And there are ways that that can be done carefully. I think the points that Mr. Green were making, don't throw the baby out with the bathwater, because again, the biggest stress, the housing boom took away so much of our business from the unsustainable lender that the witnesses up here were not willing to engage in, and the reckless lenders took our business away and then crashed the economy, and we took the hit for that, and we're still feeling that pain. And so sustainable, robust growth is what our goal is here. And with some small changes in these places, you can make a measurable impact there.
And thank you for that response. Mr. Motley, you brought up some interesting scenarios in your testimony about what could help the mortgage industry and our housing industry. In effect, One would be the CFPB ability, the repay rule that CFPB has, the qualified mortgage. You know, the Democrats have proposed to exempt community banks from qualified mortgage rule, provided that their mortgages are held in portfolio. Would you comment on that?
You know, I think that, first of all, we appreciate the idea that, or the concept that there might be some attempts to stimulate lending. Portfolio lending is an important factor for banks as investments, but I caution the use of portfolios to add loans that are not standard. I think that the QM rule could be adapted for all lenders so that the consumer knows what to expect when they go to a bank, whether it's a small bank, a community bank, or a large bank. The rules of the qualified mortgage, I believe, should be the same for everybody.
Thank you so much. My time is up.
Time has expired. With that, we go to the gentleman from Florida, Mr. Posey, for 5 minutes.
Thank you, Mr. Chairman. Mr. Motley, you mentioned in your written testimony that in recent years, the Department of Justice has aggressively pursued enforcement actions under the False Claims Act against lenders participating in the FHA insurance programs. I certainly believe that if you defraud the federal government, you ought to be held accountable. And in regard to the FHA, we all want to ensure that FHA is protected from risky loans and is on sound financial footing. But it's my understanding that the Department of Justice has now sued and settled with nearly 30 companies for violations of the False Claim Act. All of these companies were accused of misrepresenting the quality of the loans to the FHA. Those are pretty serious charges. If the Department of Justice is finding issues this widespread with so many of the program's participants, and I'm assuming that these were not intentional acts of crime, shouldn't HUD step in and try to address the problem? In other words, instead of shooting for settlements, it seems like it would make more sense to ensure everyone knows how to comply with the regulations so we can actually prevent real harm from happening in the future. I mean, I think if there were intentional criminal acts, those people ought to go to jail and we ought not be making settlements. That's how you really change behavior for the future. But assuming that's not the case.
Well, I think the False Claims Act has been utilized as a sledgehammer to kill a fly in many cases, because many of our members have been subjected to False Claims Acts for errors in calculation of income, perhaps a minor omission, unintentional omission of a deposit or some credit issue that we were not aware of when the loan was made, and yet when that loan, if it goes into default, it does go into default, and then suddenly the lender's being faced with a False Claim Act. And so now not only do you have the loss of the loan and you have to indemnify HUD, but you also have treble damages. So the penalty doesn't fit the crime in a lot of these cases. Now, we are not advocating, and let me be very clear, if a lender is guilty of fraud or a conspiracy to violate the rules on a regular basis, then that's an appropriate use of the False Claims Act. But for one-offs, for errors in processing, for mistakes that are going to happen. I mean, the rules are very, very prescriptive. You start thinking about the loss mitigation protocols that the FHA requires, which are not standard, like Mr. Calhoun was talking about earlier. They're different than the agency's protocols for loss mitigation. We need to standardize those loss mitigation protocols. But if we make a mistake in an FHA loss mitigation process, we haven't experienced it. We have other members who have experienced it. That becomes a false claim when the loan goes into default and they file a claim. And so that sort of mismatch between the crime, the so-called crime, and the punishment needs to be right-sized. And the False Claims Act, we believe, should be used in a very limited, specific, egregious, when there's egregious activity.
Yeah, I was going to ask you what steps HUD can take, and I think you've already said it, just probably be much clearer and delineate exactly what is and what is not in bounds or out of bounds on the False Claims Act. Absent HUD providing clarity, how will the DOJ's aggressive enforcement actions affect the lender participation and, more broadly, access to FHA credit? Have you seen a negative impact?
We certainly have seen an impact. A number of lenders, one that I'm sure you've heard of, Jamie Dimon's been very vocal in his concerns about participation in the FHA program, and he says we can't be in the FHA program, the risks are too great. And so the reason for that is that there is not a good protocol. What we need is a taxonomy of rules and procedures in the FHA guide that will allow lenders to have clarity and certainty in the way that they participate in FHA lending.
Yeah, do you know offhand when they make these stipulated settlements, where the money goes? Do you have any idea?
I'm sorry?
I'm curious if you know where the money goes in these stipulated settlements when they make them.
I don't know specifically. I think it goes into the coffers of the federal government.
Yeah, I'm wondering if they're making bounty hunters out of DOJ. I just have to wonder about that. Thank you, Mr. Chairman. I see my time's up.
Gentleman's time has expired. I understand that Ms. Moore is wanting to pass on her questions. Is that correct?
Thank you so very much. I just wanted to ask the
we'll
panel.
recognize her for 5 minutes then.
Thank you.
Okay.
I just want to ask the panel, I know that smaller banks were not the cause of our financial meltdown, and excuse me if I ask questions that have already been answered, but we have seen banks become more profitable, including smaller banks. And so I guess I would want to hear from you all what your thought is about analyses that suggest that that part of the problem for smaller banks has been an effort to try to develop growth at a very fast pace, and a lot of the losses were due to aggressive commercial lending, because Dodd-Frank, of course, we exempted these banks from the CFPB, gave them a sort of a tiered structure with regard to regulation. So I was wondering if you could just share with us what lessons perhaps the smaller banks have learned with regard to rebounding from the crisis, because I'm not sure all of it is because of Dodd-Frank.
I'll take a stab at that. I'm not sure rebounding is the right word, though, because I think earnings are a thing that you can look at and say, okay, does that balance everything? But not really. You've got regulatory issues that we've been dealt with since Dodd-Frank too that's adding in there. So when you start taking and looking at earnings as a whole, are you looking at larger bank earnings? You're looking at community bank earnings? I know they've gone up, but for my case, my earnings have not gone up. I'm dealing with a lot more regulation because of a lot more expense that I'm having to deal with today than I did before Dodd-Frank.
But you would also stipulate that you would also recognize that a lot of the regulation for larger banks, smaller banks have been excluded from in credit unions.
Well, you're saying excluded. I'm not sure we've been excluded. Maybe there's been a box that we fit in, maybe we get 50 basis points difference or something for exclusion. But really, as a whole, we're still subject to HMDA, all the different things that we have to do in a greater degree.
So the tiering, you don't see that we have done is adequate enough?
I don't think it's...
Is it the wrong approach totally, or?
I don't think it's a wrong approach. I just think it's not enough for small community banks and what we're trying to do. I think that's what we need to push back and say, hey, we need some real regulatory relief that'll help us, that doesn't add on to what we're currently doing. All we did is get 1,200 new pages of regulation in each of the different regulations that came out of Dodd-Frank.
Well, I guess what I would like to hear from the panel is whether or not you think that Dodd-Frank had a useful purpose. I mean, you're obviously none of you are Wells Fargo or some of the other actors that we have had to find, and there was a tremendous amount of mischief leading up to the financial crisis. And so we have not wanted to penalize those actors that were not a part of it. But I guess I'm concerned about whether or not you all think that there's something in between just sort of jettisoning Dodd-Frank. There's some concrete improvements that we can make and not just say we don't need a regulatory framework.
Well, if I may, the NBA is not proposing that we jettison Dodd-Frank at all. There are a few things that we would like to see happen to make the QM rule a little bit more inclusive for all borrowers, low to moderate income borrowers who are stifled in many cases because of the treatment of points and fees and the limited cap on that. So we'd like to see an expansion of that. We'd like to see some relaxation or some differences in how we interpret the debt-to-income ratio.
So do you think this has an impact on like minority borrowers who have suffered?
It has a definite
lot?
impact on minority borrowers because of and I mentioned earlier before you were here, what we find in multicultural families is that families will go together, they'll pool their resources in order to afford a house. That's often very difficult to document, and in many cases it could be over that 43% debt-to-income ratio. If for some reason that loan is not eligible for Fannie Mae, then we can't go over 43. It'll be an illegal loan. So unless we wanted to keep it in portfolio, I suppose you could do that. But then you've got the risk of a loan that's not nearly as liquid. It's frowned upon by the regulators. So tweaks to the QM definition would be the thing most helpful, I think, in expanding the credit box.
Thank you so much. My time has expired, and thank you for your indulgence, Mr. Chairman.
Time has expired. Mr. Heitkamp's going to leave here in a second. Before he leaves, there is one question that has been asked yet, and Ms. Moore went to part of it here, and I want to sort of jump in here right quick and get a clarification before you do leave, Mr. Heitkamp. And that's with regards to the subject of profitability of the community banks. I think, from the standpoint that you've seen some earnings go up, I think the point that you made a while ago, and we may need to clarify just a little bit further, is the fact that small banks, say 250 million and under, are the ones that are really, really feeling the pinch of the regulatory costs. The FDIC did a study a few years ago that showed that they didn't anticipate banks under 250 billion even being around in 5 years, or 250 million, excuse me, 250 million. And so, for clarification purposes, would you agree with that statement, or like to expound on it and sort of?
Definitely, I think that's really important to talk about today because.
So you're looking at banks with 750 to $1 billion. They're doing okay, but the littler guys are the ones that are where we're talking about.
I'd even say 500 million and below. They're really suffering. I think that I heard a study that was like $350 million. You had to be that size to survive today.
Okay, very good. Thank you. Thank the committee for the indulgence. Mr. Heitkamp will be leaving here shortly, but we're going to go to Mr. Tipton next. Gentleman from Colorado is recognized for 5 minutes. Oh, wait a minute. Pardon me, Mr. Go ahead, Mr. Tipton.
All right. Thank you, Chairman. That's a great segue, actually, into the questions that I had. I come from a small community. And Mr. Heitkamp, it certainly catches my attention, having participated in a small community bank, when you're talking about a 300% increase in terms of some of your regulatory costs. I had one of our small community banks contact me several months ago and said, good news on the employment end, we've made 3 new hires. The bad news is they're all for compliance. And those are the real challenges, really, when you say that our small community banks are really facing. There was a recent Bloomberg News data that showed that loans of $1 million or less to Main Street-style businesses has fallen to 20% of total business credit from 35% in 2004. Consumer loans as well?
Yes, sir.
And have you seen an impact on small business formation? That's one thing I think that we forget in the mix. Since we've been keeping records for the first time, we're seeing more small businesses shut down than there are new business startups. And as our chairman is often noted as saying, it's hard to have capitalism without capital. You are the liquidity in the marketplace. Are you seeing that with your small businesses in Texas?
Yeah, we're definitely not seeing as many applicants as we've had in the past. I think the people are sitting on the sidelines seeing what the regulatory issues are and how they're going to impact them before they invest those capital dollars. And so I think that is a deterrent to seeing small business grow.
When you're seeing some of the difficulties of being able to make a loan that perhaps you would like to be able to make, but regulatorily you are not allowed to make, do you see them turning to alternative financing, and what might that look like?
Yes, I think if they can't get the loan from a commercial bank, they're looking for it other places. Sometimes they're going online. You see these online lenders, things like that, but it's really not a good alternative for them because at the end of the day, it's going to come back to haunt them.
Higher costs?
Higher cost.
Higher costs and perhaps more business failure there. You know, in your testimony, you advocated for regulatory reform that would require the federal financial regulators to conduct a cost-benefit analysis as part of the rulemaking process. How would this improve the final rules, in your opinion?
Well, I think knowing if you're doing the cost-benefit analysis to say, okay, does this make sense before you apply a rule or a regulation and making sure we talk about it, I think that makes a lot of sense for us to say how the effect will happen to that or what effect will become of that.
You know, you're probably trying to get out, and that's why we're all going to pick on you here in the short term.
That's okay.
But, you know, we recently had Chair Yellen and a variety of regulators that have come in, and they've always noted the trickle-down effect of regulations. But then they'll cite they're doing everything they can to be able to relieve that regulatory burden that people are facing. Talked to a couple of community bankers just a few days ago when they were in town, and they were talking about the best practices ultimately trickling down. Are you seeing that real impact on you and impacting your ability to maintain that small community bank?
Yes, we are. The best practices are, you know, I'm worried about the new one's going to come on down the road is looking at our small business customers and the compliance they're wanting to put on small business and gathering data and everything that you're hearing about that's starting to gear up. We've had regulators start telling us, hey, gear up for this. That's going to be additional cost and additional burden that we're going to have to do if we have to get into small business lending like that.
Just one final question from me so that you can leave if you must. But what I think is really important for us to be able to understand is that community bank. When you're talking about the mergers, the acquisitions, it's always with the idea of being able to get the benefit of synergy of a larger entity. But what does a community bank, somebody that you're describing, somebody that lives and works there and understands the people that they're trying to be able to make loans to, what's important about that?
Oh, I think that's the key driver of a community. I mean, knowing the people that you deal with, you have the certainty of, we've built that relationship over years, you can trust one another. That's hard to get, and that's very valuable, and that's my opinion of a community bank, and that's why it's so important that we keep these guys.
Yeah, thank you, Mr. Heitkamp. Appreciate it. Mr. Motley, I'd like to be able to ask just one question of you. You mentioned in your testimony the tightening of mortgage credit availability and the increase in origination and servicing costs. We have a bank in Westminster, Colorado that told me their branch had to shut down the majority of their mortgage group from 15 to 4 people because the business model simply no longer made sense. According to them, they lost jobs because of the regulatory burden. It was too much. In your opinion, does the current regulatory framework for mortgage lenders balance safety with access to credit for customers?
Excuse me, I think it can be improved upon. I think by making some tweaks in the QM rule, I think by providing clarity, written guidance from the CFPB, we could do a better job of expanding the credit box and allowing more people to qualify for mortgages.
Thank you. My time's expired. Thank you, Mr. Chairman.
Gentleman's time has expired. With that, we go to the gentlelady from New York, Ms. Tenney, recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for being here to testify. I had some questions for Mr. Heitkamp, or at least some issues. I, too, come from a small business community, rural upstate New York, where I actually own a small business in the area, and we've had many issues with access to credit. And one of the problems we have is so many of our small businesses and smaller banks have been displaced because of the regulations and just the huge amount of compliance that we've had to deal with on our business as well. Coming from New York State, which is one of the highest regulatory states, whether you're in banking, small business, high energy costs, taxes, you name it. If there's an unfunded mandate to send to our local governments or schools and our small business community, New York will find it. So. Part of that question I had, and I was going to ask Mr. Heitkamp, but I can put it to the panel, or specifically would like to say something to address Ms. Wade because of my family's business and dealing with financing. And one of the problems we've had is trying to get access to capital with banks because of the new regulations. And I find that some of the community banks haven't had an opportunity, are really not in our league anymore. And I just wondered if there's any evidence that you have, and I know you may have spoken on this, and I apologize, but I want to hear it again, if there is other avenues that you've cited or indicated in your testimony that where banks or small businesses are going for credit if it's not to a banking institution, and if you could just highlight a couple of those that maybe other alternative forms of credit as opposed to using a bank.
Sure. Their primary source of funding for expansion or reinvestment in their business is the revenue of the business. So personal financing, savings, borrowing from friends and family if they're new, those are the main sources that they're drawing from. And then it's the bank that they have their primary relationship with is where they're looking to access lending. I think one of the areas that is frustrating for many small businesses in this new banking regulatory scheme post-Dodd-Frank is the area of uncertainty, not knowing why they might not be approved for the full amount that they're asking for, and not having a response from their bank representative being able to explain what if it's paperwork that they're not filing or why they aren't accessing why they're not able to access all the credit, and not realizing that maybe having a relationship with a secondary bank might be important. But they certainly draw on credit cards. More are looking at online fintech lending options in accessing credit. But for the most part, right now, it's most of their financing is coming from personal savings and revenue from their small business.
Yeah, you just described exactly the circumstance that I myself have been in, maxing out my own personal credit cards and getting second mortgage just to get past some of the cyclical nature of the businesses that we're in. On the fintech, that is something that's becoming talked about often in Washington. And can you just tell me any thoughts you might have on regulation in the fintech space and how that would affect our small business and banking community, in your opinion?
It's still a very small portion of lending for small businesses. More are becoming interested in accessing or learning more about what products are available through fintech. And one of our concerns is over-regulating this area of financing before it develops into something that might be very helpful for the small business community as they are maybe losing some of the relationships that they have with their small local banks and are forced to bank with larger banks that they have a less successful time accessing credit. So some of that, I think, is spilling over to the fintech arena, and making sure that that's still a viable option is important.
So you're saying that the over-regulation of the fintech business could be causing the inability to get credit on that side?
Well, we're certainly concerned about over-regulating of that industry, where it wouldn't be a viable option for small businesses to access financing going forward.
Thank you. I think I'm out of time. Thank you very much. I appreciate it.
Gentlelady's time has expired. With that, we go to the gentleman from California. Mr. Royce is recognized for 5 minutes.
Well, thank you, Mr. Chairman. If I could just say to the panel here that combating money laundering and combating the financing of terrorism is obviously something we all agree is critical to protecting our citizens, protecting citizens throughout civilization. I'm concerned, however, that we are misaligning our resources and hindering legitimate customers and businesses from assessing capital in some situations. And I thought I'd just bring this up. At least one recent study by the Clearinghouse concluded that billions in bank resources, billions are spent on AML-CFT compliance that have limited law enforcement or national security benefit. So clearly, the system as currently designed is outdated and is ineffective. And so my local banks tell me examiners are more interested in quantitative measurements like the number of compliance officers that are hired, or the number of suspicious activity reports filed,
And missing in that is a focus on the qualitative side, which would be results-driven risk management, which identifies and catches bad actors, and we haven't seen much in the way of that. And so I was wondering if our remaining bank witness can comment on suspicious activity report filings and other rules and regulations, and whether you think they're working, and also are there ways to better foster cooperation and information sharing among banks, or look at the beneficial ownership rules so that we can catch the bad actors while still facilitating access to capital and access to credit for small businesses. So I would just ask you, Mr. Motley, for your views on that.
Thank you. I'll try to briefly give you my thoughts on that. We're primarily a residential mortgage lender. We are a depository. We have 8 depository branches in the Dallas-Fort Worth area. So we take retail deposits, we do savings accounts, we do traditional banking, but we're primarily a mortgage banking participant. But the AML rule is really requires us to devote a huge amount of resources to managing it. We could probably meet and talk to every customer we have at least once a year and know exactly who our customer is.
Yes.
But this AML rule, it's really it's pretty onerous, and we have to devote a single compliance person just to that one activity. We file suspicious activity reports whenever we run across it. We find that more on our mortgage side than we do in the depository side, because really we take great care in knowing who it is that's opening up an account for us. So for a bank like us, I think that rule is overbearing, and there could be some opportunity for some relief.
I'll ask you another question. Your bank services mortgages, so you're in a unique position to offer, I think, some perspective here on the proposed Basel III. Increases in the risk weighting for mortgage servicing rights. So there would be really 2 points to you, and the first would be understanding that there is some volatility in these instruments as the interest rates change. Do you believe the risk to your balance sheet necessitates higher capital requirements? And the second, and a different capital treatment. And the second question I'd ask you is, what's the impact on your relationship with borrowers if you then are unable to hold on to the servicing rights on the mortgages that you originate? Maybe you can walk us through that.
Thank you. To answer your first question, capital is important. Capital supports our business. We are a highly capitalized institution. We're at 21% of assets is our capital. And so we can support our mortgage lending activity, but Basel III will prevent us from growing that business that we've been in now for 65 years. We have 180,000 customers. We like having those customers. We have a high concentration of mortgage servicing rights to capital. Under the Basel rule, that would be restricted down to 10%. And when that happens, that means we're going to have to, one way to correct it is either grow a whole lot more capital. We're a private entity, that's not so easily done. We're also a family-owned bank. So the alternative is to let those mortgages run off or sell the mortgages to somebody else, to sell that relationship down the road to someone else. And one of the things that many of our customers tell us is they came to us because they wanted us to service their loan.
So that does impact directly your relationship with them in the sense that this becomes the experience.
It absolutely does, yes, sir.
Yeah. Mr. Chairman, thank you.
Gentleman's time has expired. We have a gentleman here today who is not a member of the committee, but has got a phenomenal background in financial services and serves on the financial committee as a whole, and wants to participate in the hearing. And without objection, the chair seeks unanimous consent of the gentleman from Arkansas, Mr. Hill, to be recognized for 5 minutes for the purpose of questioning witnesses. Without objection, so ordered. The gentleman from Arkansas is recognized. Welcome.
Appreciate the chairman and ranking member's indulgence. Thank you for that. It's always nice to have an interloper drift into your committee, so thanks for letting me participate. Thank you, panel, for being with us and sticking with the cause over this long afternoon. Chair Yellen testified before the Senate and the House in the last couple of weeks and was just emphatic that there is no lending problem in our country, that lending's at an all-time high, and that small business people, Ms. Wade, are not complaining about access to credit. In fact, she says that only less than 4% of small businesses say they have no access to credit. Senator Warren described that was the real facts, and that anyone who disagreed with Chair Yellen was in fact proposing alternative facts. So, Mr. Chairman, I'd like to enter in the record some alternative facts. An article, Why We Must Base the Banking Regulation Debate on Real Data by Paul Kubicek from AEI. In that article, it says that the Federal Reserve's own data shows that small business lending is 14% below pre-crisis levels, from $700 billion in 08 to $600 billion today. The Fed's own research shows that smaller banks play an outsized role in providing small business credit. And without effect, the largest banks have not filled the lending gap. The dollar volume of small business loans made by banks with more than $10 billion in assets declined by 5% over the same period. So I'd like the panel's views on commercial paper markets in this country. Before the crisis were $2 trillion weekly. Now it's about $900 billion. So it's my view that one of the biggest contributors to this C&I loan number up there are loans to the biggest companies in our country, our nation, that used to finance themselves through commercial paper. Does anyone have a view on that, Ms. Wade?
We've certainly seen low borrowing levels, and I think that's the missing component when folks talk about the 4% not being able to satisfy their borrowing needs, is that there aren't as many borrowers as we would normally see in an expansion. The reasons that there aren't as many borrowers, they don't feel it's a good time to expand their business. They aren't optimistic about business conditions in the next 6 months, and they're not willing to risk their profits and resources in investing in their business without a full understanding that the economy is going to grow at a rate that they will be able to pay back these loans and use the resources effectively. So I think that's one of the biggest missing components in the conversation for small businesses. And then again, for those who are seeking credit and are able to access loans, not understanding what is asked of them from the small business community, or the small banking community, sorry, and for the small banks not having that level of uncertainty. When there's uncertainty in the small banks and there's uncertainty in the small business, it's a terrible circumstance to facilitate growth in the small business community and grow their businesses.
Well, we've certainly seen that in my district, where we only, since the summer of '07, only have 1,300 more people employed in my congressional district than we did in July of '07, and only 5,000 more people in the workforce. So it's a very slow growth, as you point out, recovery, so there are not very many prospects. I want to talk about TILA-RESPA, Mr. Motley. Urban Institute thinks that there'd be about 5 million more mortgages made if we didn't have the combination of TILA-RESPA, QM, ability to repay in that period. And if you look at S&P data, home equity loans since 2011 have declined 3% per year in that period of time. And there's no doubt that one of my constituents in my district reported that just over the last 3 years, his qualified mortgage loans since 2013 have dropped 15% a year in eligible credit because of the rules. What do you think we can do to improve TILA-RESPA? And I know you've already put on the record ability to repay and QM, so what are your thoughts on TILA-RESPA?
The penalties of failing to execute the TRID rule disclosures properly can be catastrophic for a small lender because that loan is going to end up being most likely non-saleable, not going to be able to be delivered to another investor, private investor. While Fannie Mae and Freddie Mac don't regulate disclosures, they do expect lenders to follow the rule. And the private, without Fannie Mae and Freddie Mac and the GSE patch that we have right now, lenders would be hurt quite badly because the rules are so specific. Investors are reluctant to buy non-QM loans because of the penalties that are associated with it. So I think that what we could do to improve upon it is to, A, provide better written guidance that can be relied upon by the CFPB. I think that would be the best thing we could do. And then the second thing we could do is to expand in a moderate way the definition of a QM loan, specifically as it impacts low to moderate income borrowers.
Thank you, Mr. Chairman. Thank you for the time, Mr. Chairman.
Thank you, gentlemen, for joining our committee today. And with that, we're at the end of our committee hearing, and would certainly like to thank our witnesses. We had a great panel today, a lot of great information. One point of clarification, Mr. Modley, in your testimony, you talked about the increased cost of doing a mortgage loan, and my calculation said that it increased about 70% in the last 7 years. Would that be pretty close?
That'd be pretty close, yes, sir.
Just rough ballpark figures there. That's breathtaking. Whenever you look at that cost having to be passed on to consumers, I mean, it's a significant enough cost that I'm sure that it makes a difference in some people's ability to even take out a loan. So I thank you for that information. Also, I know during the committee the points were made with regards to Community Reinvestment Act, Bank Secrecy Act, and appraisals. A lot of you made points on those three things, and those are going to be items that we're going to talk about in succeeding hearings. We believe that they've been brought to my attention by a lot of other banking groups, people in the financial services industry, that there's concerns, problems, issues with those that we need to take a look at. And so we appreciate your testimony along those lines because, again, it points out that I think your testimony shows that there is an interest and there is a problem there that we need to take a look at. So I thank you for that as well. But again, thank you for your participation here. It's been great. Without objection, all members will have 5 legislative days within which to submit written additional questions for the witnesses to the chair, which will be forwarded to the witnesses for your response. I ask our witnesses to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with that, hearings is adjourned.